The next one are deferred sales trusts. Now that's an option. Sometimes it's the right choice, sometimes not. A deferred sales trust is simply you have an attorney set up a trust and you sell your asset to the trust, and the trust sells the asset to the final buyer, and that trust keeps the cash, and you take a note. You take an installment note back from your own trust, essentially.
Okay.
And the I guess the benefit to start with is that, I remember I mentioned Code 453, that's the installment sale, that regulates when you get taxed on when you receive your payments. If I sell you X as an asset and I take a note back, seller financing is what your audience will know about. If I take interest only and then the balloon due in a fixed period of time, I get to wait until I receive that sales corpus. That is a great benefit. Now, would I do that if I knew you, if we were next door neighbors and I may sell you my house and I say, Scott, I'm gonna sell you my house for $1 million and I'm gonna carry paper with you for 2 years, then you can pay me what you owe me. I'll pay a little bit of interest, we'll charge 5-6%, something like that. That's great. I get to wait until I get that final payment because that's principal. If we amortized it, I would have to pay some tax along the way because specifically in the code, Code 453 little c, for your listeners that want to look this up, taxes due pro rata with receipt of principal. Okay. So that really now, when you know the rules, you can evolve your strategies. Okay. Okay, so would I sell you a piece of property and carry the paper for 30 years? Well, I would get a wonderful tax benefit. Then the flip side is I don't want to wait for my money. So we'll talk about that later when we get into some of the more esoteric 453 strategies. But the deferred sales trust, back to that, is you can sell your property to your own trust and have somebody manage that money. Now you have essentially what they call dictatorial control over it, and there's a fee for management and all of that, and there's a few grand to set up, but it allows you to defer the tax. And if you want to run that as long as you want, you can do that. But if you ever touch what I started to say earlier with the problem side of it is that if the minute you touch that corpus, you get taxed. So if you don't have the strength to run it long term and really get the benefits of tax deferral, that's fine, and they're expensive to run every year. But they have their place. I'm not disparaging them. It's a unique entity, and they have their place. Excellent. The others are the two versions of installment sales under the code 453. If you have a piece of property and you want to sell it off and get your tax deferral, there's a key metric to look at, and that is, do I have 2 years or longer that I can wait for my sales principal? Okay. If I want to, let's say I'm a 70-year-old person and I want to pass the wealth on to my kids, but not in the form of real estate. This may come up. And they go, well, I really want to take care of the kids. I'm in no hurry to do this. I have a couple of years. You set up a trust, a children's trust, and you sell your property to the trust, and you take that installment note. And then if that trust waits 2 years and 1 day, and they sell it on the open market, the IRS allows for the basis to be stepped up to fair market value. So you don't pay a dime.
Can you tell our audience what that means when it gets stepped up in basis?
Basis is what did you pay for it? Let me take my cell phone here. Let's say I paid $50 for this phone, and I'm going to sell it to Scott for $100. What's my basis? It's $50. What's my gain? It's also $50. Gain is the amount above the basis. So if I sell this to Scott for $100, I'm going to owe capital gains tax on the $50, which is the profit above what I paid for it. Now that is a moving target. Remember we talked earlier about depreciation. What if I bought this phone for $50 back 30 years ago? What's my basis now? That thing, the IRS has been depreciating that now. My basis may be down to 0. So if I sold this phone to Scott, edit that out. It's the first mistake I've made.
Keep it in.
If I sold Scott this phone and I had owned it for 30 years and I've depreciated it down to 0, I may have paid $50. Now the IRS says, now, yeah, we're going to say your basis is 0. All of that is considered profit. So The recapture from 0 up to the 50 that I originally bought it is what we call depreciation recapture. That's 25% tax. And then the profit over that mark, the original basis up to where it is, would be taxed at the capital gains rates in the year of sale. Now right now in California, the Fed rate's 20%, the California rate is 13.1, I believe, 13.1 or 13.3. We have the highest state cap gain rate in any state. So that would be like 33 and some change percent that I would have to pay on that. So I'm going to get 25% tax on part of it, 33 on the other. So I'm going to get clobbered. So if I want to pass wealth on to my kids, then I can use that. We call it a 453E trust because 453 little e states it's the related parties and unrelated parties rule of when you sell something, do you get a step up in basis or not, or how long it gets held. So in that case, if I wanted to not pass the real estate on because the kids don't care about it, but I want to leave them a pile of wealth, we do the 453E trust where you sell to that, let it hold it for 2 years and a day, then they sell it off, they get that step up in basis, and then all that wealth is passed to your family in a tax-free manner.
So ideally that's the way you'd want to do it if you have the time.
If you have the time. The last thing we'll talk about is the installment sale to an unrelated third party, which states that...
Hey everyone, if you'd like more information about myself or my amazing team, check out scottnellteam.com or subscribe to our YouTube channel. Thanks for watching.